Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, January 13th, 2025. In terms of economic activity last week, the real takeaway is good news is bad news. So most of the economic metrics that came out and were delivered last week were above expectations, so you would think that would be good. It's actually bad at this point in that investors are very focused on inflation and interest rates. So the fact that we might have stronger economic activity than expected would suggest less in terms of future rate decreases from the Federal Reserve. That alone kind of spooked the markets last week because the economic data, we'll go through it, is pretty solid. Start off with last Tuesday. ISM Services Index expected to come in at 53.3, better than expected, 54.1. The JOLTS job opening, which is a new level of focus on this indicator, was supposed to come in at 7.7 million open jobs, came in closer to 8.1 million. So again, strong, market hated it. The next day we had the ADP employment change. Now that was a little weaker than expected. Expectations were an additional 140,000 jobs, came in at 122, but that doesn't include government, and it is a small sample size, so that one we can dismiss. Initial jobless claims, though, came out the same day. That was better than expected. We were expecting 218,000 new initial claims, only 201,000. Then on Friday, we had a wealth of information that came out: nonfarm payroll, unemployment rate, average hourly earnings, Michigan consumer sentiment, and almost across the board, better than expected. Non-farm payrolls expected to come in at 160,000, came in at 256,000. Unemployment rate expected to come in at 4.2, came in a little better at 4.1. Average hourly earnings in line with expectations, plus 0.3 month over month. Average hourly earnings then on a year-over-year basis, slightly higher than expected, 4.0 versus 3.9. The Michigan Consumer Sentiment Index preliminary came in a little weaker than expected, 73.2. Expectations were 73.8, but that's pretty close. So in total, economic data last week, you'd have to say, was stronger than expected. As a result, the Atlanta Federal Reserve took up their estimate for fourth quarter GDP growth. Prior week, they had been at 2.4% year-over-year growth. It's really good. They took that up to 2.7%. So all this, again, comes back to inflation, expectations for interest rates. Inflation expectations rose last week, almost 9 basis points. So now it's at 243. That's really the highest level we've seen in almost a year. It was only 5 months ago we were running in the low 2.05 area. So inflation expectations over the last 6 months have risen roughly 40 basis points. Annualized, that is kind of a big number. So we're keeping an eye on that 10-year break even. Fed funds rate expectations, and this is where investors are increasingly taking down expectations. The expectations for the next Fed meeting, 28th and 29th of this month, almost no chance of us getting a cut at this point. 3-4% probability of a cut, not going to happen. And now investor expectations for the full year, 2025, just a month ago, we had mentioned this on podcasts. The market had built in expectations of at least 3 cuts. Now we're closer to the market pricing in only 1 cut for the entire year. So what happened to equity markets and fixed income in the U.S.? Probably guess not a good week with the inflation news and the expectation of higher GDP growth, less likelihood of Fed decreases. So last week, S&P 500, after an amazing 2024, where it was up 25%, last week, S&P 500 down 1.9%. In terms of U.S. stocks, Large, small, little difference. Large did slightly better, but value did quite a bit better than growth last week. Value in the U.S. down 1.5%, let's call it. Growth down 2.25%. Rest of the world fared a little bit better than the U.S. did. The developed markets ex-U.S. down 50 basis points roughly. Emerging markets closer to the U.S. outcome, a negative 1.5% last week. China, rough week, minus 4.4%. Fixed income, again, I've already prefaced this, tough week. The Bloomberg U.S. Aggregate Bond Index down 87 basis points. We had the 2-year yield increase by 10 basis points, the 10-year yield by 17 basis points. So last year, the bond market was trailing off as the year wore on. At one point in the second half of the year, we had a year-to-date increase in the Bloomberg U.S. Aggregate Bond Index, roughly 6%. Finished the year barely positive, 1.25%, and now off to a rough start this year with the 10-year now over 4.7%. Let's take a look at economic activity that will be reported this week, starting tomorrow. Now we get a lot of inflation news. Starting tomorrow, we're going to have PPI, core PPI. The expectation is mixed on it. For PPI month over month, for December, the expectation is it rose 0.3%. November, that was 0.4%, so that would be good. However, core PPI is actually expected to accelerate. Month of November, month over month, that was up 0.2%. It's expected to be up 0.3% month over month for December. On Wednesday, we'll get the CPI number and core CPI. Again, bit of a mixed bag here. Just for the CPI headline, the expectation right in line with what it was in November, positive 0.3. The core inflation rate is expected to fall actually month over month from 0.3% in November to 0.2% for the month of December. Thursday, retail sales ex auto, again, mixed picture. Retail sales month over month are expected to decelerate, have decelerated in December, only up 0.5%. November, that was up 0.7%. So that would be good in terms of inflation fears. But retail sales ex auto, strip out autos, obviously not doing well. Retail sales ex auto are expected to increase the month of December or accelerate to a positive 0.4% month over month. It was a positive 0.2% in the month of November. Also on Thursday, initial unemployment claims. Again, last week was one of the lowest levels we've had. I can't remember last time we were under 200,000, but it was at 201,000 last week. Expectation is Thursday will be reported 214,000 is the consensus. Friday, a couple of almost throwaway. Normally these are kind of bellwether, but now not so much. But we have building permits and housing starts, both for December, both going to be reported on Friday. Both of those indicated, well, they're mixed. Building permits are expected to come in slightly below what we saw in November. Conversely, housing starts are expected to be up ever so slightly from the month of November to the month of December. So that is it for our weekly economic update. We thank you very much for attending. We'll look forward to seeing you next week. Thank you.